Okay, hi. So how many of you are in startups and raising money or thinking of raising money? One. Wow, okay. Okay, well, I'm Perry. I'm mostly going to be targeted at you then, really talking. I'm mostly going to talk to you, I want to talk to you a bit about fundraising. And especially if you've never done it before or you're thinking of raising from European or US venture firms, I just wanted to give you a bit of a background on how to think about raising money, what's involved in the process, the kind of people that you're talking to. So I just wanted to give you a bit of a background on raising money. And I'm going to do it with a bit of help from some Dilbert cartoons, because everyone likes Dilbert cartoons, although some of them will be a bit hard to read, so I'm going to keep flicking through. First thing I'm going to tell you is just a bit about me. I've spent, as they say, about 20 years building and operating web businesses. I've raised money for two venture-funded startups, one in online healthcare, one in online financial services. I've probably raised about $40 million overall. I helped grow a third business, Zulily, to IPO. It's a $5 billion public company in the US. I used to be a partner at a venture firm called Chase Episode 1 Partners in London. We had a $150 million venture fund. And I'm now a venture partner at Amadeus, which is another big UK firm. So I know a fair amount about raising money, both as an entrepreneur and as an investor. And I thought I'd just give you a couple of bits of background on raising money and what's involved. So the first thing you really need to think about when you're raising money is what's the right kind of money to raise? What kind of money are you actually raising? And it's worth thinking about, depending where your business is, what sort of money you need to raise. The real background here is there are a lot of ways of funding early-stage businesses or businesses of any type, and they vary depending on the type of business and on the stage that your business is at. And I know there are some venture capitalists and investors here today that you're probably going to pitch. The issue with venture firms is that they're relatively late in the process. So if you're just starting out and starting your business, there are plenty of sources of capital like debt, your own money, friends and family, business angels, accelerators, incubators, who are probably a better source of funds than talking to institutions. The thing to be thinking about early on when you're just starting your business is, if I'm going to want to raise money from venture capitalists at a later stage, what does my business need to look like by the time it gets there for me to be able to effectively raise money? And I guess the most important thing here is that venture firms are really most relevant in the growth of your business. So if it's early and you're trying to prove the concept, explain how it works, is there a market opportunity, have you got a decent team, that's not really the right stage to be taking institutional money. It's really when you've got some proof of concept in a big market that you want to grow it out. Venture capital, just so you understand it as the type of money when you're pitching these guys, as you probably know, the way funding works generally, you can do anything from put your money in a bank account all the way up to walk into a casino. And venture capital is right up at the high-risk end. It's right at the casino end of investing. So venture firms in Europe and in the US, they're not looking for a safe reason they get their money back 2 or 3 times over. They're looking for a very small chance of something very big happening. And one of the things that a lot of people pitching venture firms don't understand is the dynamic in venture capital is, I don't want you to have a low-risk, reliable way of getting me my money back. I want a very small chance of some very big, unlikely event happening where 1 in 10 of you are going to go very big or go home. Similarly, it's worth understanding that every firm is quite different. So when you pitch venture firms, they have different amounts of money, they're at different stages of their fund. Some of them may have run out of money, their fund may be closing, they have a term typically of 6 or 7 years, and so they may be running out of money. You need to understand, when you're pitching investors, they're not all the same. Some investors have no money, they're late in their fund, they're early in their fund. They have a timescale where they need their money back in 3 years and 4 years. And the key thing is you need to, like any sale, understand your audience, because your own proposition needs to fit to what they're looking for as much as whatever it is you want to sell them. So you can keep pitching me on, I want to do a thing that takes 7 to 10 years, but the reality is my fund may not be a match for what you're doing. So it's well worth asking and understanding a fund you're pitching to where they are in their fund and what they're looking for. Similarly, there's an important dynamic that happens where a lot of early-stage businesses that have ever written their business plans and pitched me often think they need to raise certain amounts of money, like $1 million. Well, $1 million in the UK and the US is the hardest sum of money to raise, because typically it's too small for venture funds and too big for seed investors. So what typically happens is you need to understand a bit about the economics of a venture fund, because if you're a venture fund in the UK or the US, what happens is you typically, to make your own economics work, you typically need a fund that's $40, $50 million in size, and I'm going to do the same amount of work on one investment for $100,000, $1 million, $10 million. So in a $40, $50 million fund, I'm only going to make 10 investments. And so if you want $1 million, that's just not enough for me to want to do the work on it versus somebody who wants $5 to $10 million. So when you're pitching a VC firm, you kind of need to understand, based on the size of their fund, what's the right amount of money to be looking for. So it's all very well sitting there writing your own business plan and thinking, I actually need $1 million or $1.5 million, but that can be a very difficult sum of money to raise, because you're not necessarily understanding the key thing is the audience that you're pitching to and how much money works for them to be putting into what you're doing, if that makes sense. I'll let you read this one for a second. The next thing I want you to just talk about a little bit is to understand a bit about the customer that you're pitching to. I want you to understand a bit about what the venture firms are doing and thinking when you're pitching to them. So this is probably the most important point, in a way, if any of you are startups, and that most startups get wrong, in my experience. When you're a VC, 95% of the people who come and pitch you and tell you all about their product. I've got this great product, it'll do this, it has widgets, people, has a flashing button on the right, it has smiley faces, and most people will pitch you on their product. And venture firms and investors, I'm not interested in your product. I don't understand your product. I don't know your world. I mean, I'm interested. I want to know what it is, but I'm not looking for a great product. And then about 3 or 4% of people will come and pitch you on their business. They'll tell you about the economics. So, well, we get paid $50, and it costs us $10 to acquire them, and that's pretty good as well. That's better than just telling me about your product. But there are a lot of great businesses, like, say, services companies, ad agencies, PR agencies, which are people businesses. And so when you sell those sort of businesses, a very good business, they generate lots of cash, but they don't sell on a big multiple because you're basically buying the resource and the people. So they don't make for great investments. They make for good businesses, but they don't make for great investments. And the key thing here is a venture firm is looking for a great investment. My job is to get in and out and make more than my money back this many times. So when you're pitching a venture firm, if you're very focused on your product, even if you're talking about the economics of your business, you really want to be what you're really selling is why this is going to be a great investment for them at the end of the day. And a lot of the time, you probably read the tech press in the US, what sometimes happens is everyone gets very hung up on their high valuations and how much, and actually, you don't want to raise too much money. You want your investors to make money, because if they make money, you'll make money. And raising too much money early is not a good thing, generally, because then when you need more and you go back, you have to raise at a lower end. So I guess understanding your audience and that they're looking for investments and not for businesses or products directly is kind of important. The other thing that typically happens is most venture firms have a standard set of criteria that they'll talk to you about. So venture firms will say, we want a great team, we want competitive, sustainable advantage, we want to be able to exit, it needs to be in a big market. And they're all the same sorts of things. Typically, and especially for people in emerging markets, the one that people fall down on that I highlighted on here is really about the size of the opportunity. So coming back to something I said before, the key thing I'm looking for is a very small chance of something very big happening. You telling me you have, I'm selling colorful socks online, and the market for socks is $2 billion, and colorful socks is $10 million, it's too small. Because at the end of the day, I need to sell this thing on a large multiple, so it needs to be into a big market. And the biggest thing, the first hurdle most entrepreneurs fall down on, is that they have an opportunity which is nice and interesting, but it's just not big enough for me to put enough money in to get it out at a big enough price for us all to make enough money at the end of it. And so make sure, A, that it's not just the market that you're pitching me, but that the addressable market, the actual market that you can capture, is big enough. The other one I was going to say is, the last point on here for venture firms is typically, venture firms they're not always the smartest people that you've ever met in your life. Or they're smart at making investments, they're not necessarily smart at sort of running businesses. And typically they can't deal with multiple risks. If you're pitching a venture firm, I can't really deal with, I've got operational risk, market risk, growth risk, funding risk. I can kind of deal with one risk that you're raising this money to mitigate. As soon as I've got multiple risks, it's too much for me. And that's the one other important thing I was going to say here is, being based in Lithuania and pitching yourself as a Lithuanian firm is an additional risk to any other risk you may have for a venture firm. So they tend to invest very close to home. They invest in what they know and who they know. And if my one risk is the market going to like this? Fine. But I don't want to take the risk that, well, where are these guys? Is the economy stable, etc. So in a funny way, if you're raising, at least from European venture firm, UK, the US, the more you can look and feel as if you're a UK-based company or a US-based company, the better it's going to be and the easier it's going to be for you raising money. So showing up as somebody from Lithuania, in my experience, I live in South Africa, and lots of great businesses in Cape Town and South Africa, but you show up and you say, I'm in South Africa, and they're all like, oh, okay, story's over. I don't care how great and big it is. Like, you're miles away, I don't understand. Africa's dangerous. We'll see you all, sort of thing. Just a couple of quick slides, things to be aware of as well. You are going to give away quite a lot if you raise venture money. So just eyes open, if you raise money from venture capitalists, you lose ownership over time when you sell the business. You are going to lose some degree of control. Venture capitalists are very, there's no point pretending that it isn't important to them to protect their own money and their downside risk, and that if things go wrong, they have control. So you are going to lose control. They're going to push you to exit. They're going to have big ambitions, and that's not good for everybody. Necessarily. If your business doesn't suit that profile, or you want to make sure you keep control long term, don't raise venture capital. It's the wrong type of money for you. These things are going to happen. The good news, though, I mean, if that's the bad news, is that you will get a lot from a venture firm. So you'll get somebody with deep pockets, you get experience, you get contacts, you get a partner who's going to be with you, and you can potentially make more money for it. But you have to go in eyes open, really, with that trade-off. Because although you might read the tech press and think raising money is an end in itself, we raised $50 million, $50 million doesn't come without any strings or any responsibilities or any burdens. So when you raise money, be aware there's good things that come with it. People will help you, they'll partner with you, they'll build you network, but there is a price for that. So you're going to lose some degree of control, you're going to have dilution, all sorts of other things. If your eyes open to it, it's not all roses and we raised money. The last thing I was going to tell you a bit about, just, I don't know where we are on time, but the last thing, I've been quite quick, so I'll sort of take some questions after, but was just a bit about the process of raising money. The other thing people don't tend to know is actually, while you're raising money, what the process typically involves. Excuse me a second. So, a couple of things when you're raising money. It's not an easy process, and the key thing is you really want to go to a venture firm with a warm introduction. So although I can tell you that a venture firm will have a set of criteria about the market and the product and all this other stuff, at the end of the day, it's all about the person that you're selling to. So when you work with a venture firm, the guy who's the partner in the investment firm, he has to go and persuade all his other partners who are equally stupid, knowledgeless, busy, that they should really want to do this. And the job is you've got to keep going back and going, no, I think we should do it. Yes, there's risk. Yes, there's a problem. I've got to do it. It's hard for that person. So it's a bit like when you buy a flat or you find a job or you find a wife where you think you have some criteria, like in the flat, it needs to have some outside space, it needs to be in central Vilnius, it needs to be, but when you walk into the right flat, you just know it and you have to do it. And though they have to be in love with it, it's not just a sort of rational set of questions I've answered. So you really need to find an individual who's hugely bought into what you're doing and is willing to go through all the pain and headache of selling that into their colleagues. And it's not like, and that relates a bit to my second point here. Venture firms, when you pitch them, if you think about it, if you had money, they have no good reason to really say no to you. So if you come to me and you say, hey, here's my business, I say, oh, it sounds brilliant, I love it, fantastic. I wish you were this little bit further. Come back and talk to me in 2 weeks when you're here. Why would I ever say no? I want to keep an option open that if you do become interesting, I can always talk to you, right? Now, the problem is you're hearing, oh, great, he wants me to go away and do this and find out. And that's often a no. That's often, sorry, I'm not in love. I'm not chasing you. You're chasing me and coming back to me. And one of the biggest things when you're raising money that can really waste a lot of an entrepreneur's time, actually, and is difficult in raising money, is that venture firms don't typically say, no, I'm sorry, it's just not a business for us, it doesn't work, because why would I? I'd love to keep my option open. You might turn into something great. You might come back and be interesting. So you've got to be careful when you're pitching VCs that what you're hearing, try and get them to the point where they're saying to you, no, not now, I don't want it, because otherwise you can spend a lot of time in their process. They'll say, I'm super interested, will you tell me when you've got 5,000 users, come and talk to me. You'll come back and you'll say, I've got 5,000 users, and they'll go, oh, I'd love to see you when you've got 20,000 users, and they always want you to be a bit further. And so the key is make sure you know what a no looks like. The only other things I was going to say on here is that raising money is a hard process and it can fall through at any point. So even if you've got a term sheet and they've agreed terms and they start doing diligence and one of the other partners doesn't like it, there's lots of reasons these things can fall through, and you need to keep a big pipe. It's like a full-time job, pretty much, raising money. So be aware it takes a lot of time and it distracts you from running your business, and so you want to be aware it's a long thing. And the other last point on here, which is just a short one, is that the objective isn't to raise money. You don't get to the point where you raise $10 million and you go, oh my God, I raised $10 million, I've finished, let's go home. That's actually when it starts. So you've got to be aware that you'll put a lot of effort in, and then at the end of it all, that's really when you're going to start working, and they're going to work you harder, not when it ends, if that makes sense. So the only thing I was going to say other than that, I work in a later stage fund. I work in a fund that does $5 to $7 million checks in sort of businesses that are quite established, $2, $3, $4 million revenue run rate. And I'd love to talk to anybody about those sorts of businesses if you're later stage and have revenues. I'm not a seed or an early stage investor, but I know there are quite a few of them here. I've met a couple of them in the other room, and it's well worth. The more investors you talk to and pitch to, the better your process of pitching becomes, because you learn from what they ask you and the concerns and the objections, what it is you've got to overcome with the next guy and put that up front. And so I would definitely encourage anyone who's thinking of raising money, even a long time down the road, to start the process and do it as often as they can, as early as possible, because you'll get a lot of rejection, but you'll learn a lot about what you should be doing through the process. I think I'm pretty much out of time. Is there anything, does anyone have any questions? Is there anything I can tell any of you about raising money or startups or fundraising or anything else?
Don't be shy, don't be shy. This is a once in a lifetime.
Once in a lifetime, hardly.
Maybe I have one. If they don't have, okay,
Oh, sure.
we have one.
It looks like there's one here as well. Go for it.
Hi.
Hi.
So you said about like hiding our identity, Lithuanian identity. So what is the best way to do it? Like?
Yeah, do you know, it isn't to hide your identity. It's really about, well, it depends where you're raising money. But the main thing is, if you're not a UK-based company, for example, with UK accounts, it's very hard for me to understand Lithuanian ownership structure. Am I going to invest in a Lithuanian company? So funnily enough, there's a business in South Africa who just raised from one of the very big London tech firms, and they're headquartered in London, which means they have UK accounts, they have a head office, they have 1 or 2 employees there, but they have 30 people in South Africa, because it's cheap to operate and cheap to run. But the venture firm managed to persuade themselves, oh no, listen, they're a UK firm that happens to have their tech and operations internationally. They're not a South African company that's trying to raise money from me in Rand and Rand salary. Do you see what I mean? So a venture firm doesn't have a problem with you having operations overseas and sales and marketing overseas, but they kind of care, are we going to have board meetings here in London, close to home, where I can call you up and you'll be here and you have an office and an address. And Americans are even worse at this, I have to tell you. So we raised money from the 2 big East Coast VCs, Union Square Ventures and Spark Capital. And unless you look and smell American, it's too complicated for me. So it's really about, have I got a Delaware Corp, US accounts, headquarter in the US, an office address somewhere, maybe my CEO comes here pretty regularly. Do you sort of see what I mean? You don't need your whole team there full time by any means. They can get their head around our tech and operations is somewhere else. You've just got to look and smell like you're a local company.
If I understood correctly, execs are at the London, not in the South Africa.
Well, so I help advise TransferGo, who you may know, who are a company based here. TransferGo has a UK office. Most of their tech and operations are here, but you know, for all intents and purposes, a British venture firm can definitely get their head around they're a London business that has a, you know, Latvian, Lithuanian sort of fundamentals to their business. The management doesn't have to be always based there. It's just, can you make a reasonable case that our head office is here and our center of gravity is here, even if it's not the reality of where you do your business every day, if that makes sense. Whereas as soon as it's, no, listen, it's I mean, in the US, if you're a European company, it's a bit like, oh, European, you're foreign, I don't understand, why do I need to talk to you? Like it's, you know, you don't look American, I don't, that's great, but I've lost money in Europeans because I'm too far away. They sort of want to feel like they're close and that it's something they understand.
Thanks a lot.
Great. All right. Thanks very much.